Chapter 2, Economics, the Framework for Business. There's a lot of words that are tossed around, especially in the news, that relate to economics. Well, the word economics, budget, money, recession, inflation. What do all of these mean? Well, we're going to spend this chapter defining economics and discussing the evolving global economic crisis. We'll analyze the impact of fiscal and monetary policy on the economy, explain and evaluate the free market system, and with that, the role of supply and demand. We'll also take a look at planned market systems. And after reviewing those systems, we'll take a look at the trend towards mixed market systems. And finally, we'll take a look at some key terms and some tools that help us to evaluate a country's or even a global economic performance. Now, economics is the study of choices that people, companies, and governments make in allocating society's resources. When we look at this, it's divided into two real specific categories. We have macroeconomics and microeconomics, which we'll review a little bit more on the next slide. But first, what is an economy? We have to understand that before we move forward. So an economy is the financial and social system of how resources flow through society. And resources we can look at money, and we can also look at employment levels. We can look at imports, exports. These are all examples of resources that flow through society. Now, macroeconomics is a study of the country's overall economic dynamics. We look at employment rate, gross domestic product, and taxation policies. Macroeconomics directly affects day-to-day life, and it influences the types of jobs that are available for people, how much salary an employee will take home after his or her taxes are deducted, and so on. Macroeconomics is a study of smaller economic units. I think I just said macroeconomics. In microeconomics, we look at smaller economic units. We look at individuals. We look at families. We look at individual businesses. Both macroeconomics and microeconomics play a very important role in the global economic crisis, which this is 2015, and from a global perspective, economically the world is experiencing some economic unrest. So, what is this global economic crisis? Well, it started with a slump in the dot-com business, followed by the 9/11 terrorist attacks. Unemployment rose directly after that. The stock market dropped. Economic experts feared that the United States was on the edge of a full-blown recession. To add insult to injury, we have the subprime mortgage loan crisis. And what this is during 2006, mortgage companies began issuing credit to consumers with bad credit ratings or low credit scores. They had a high debt to income ratio, so meaning that most of their money was going towards paying credit card debt, maybe car debt, student loans, so on. And they also had or exhibited signs of a reduced ability to repay the money that they borrowed. And that, when we, in hindsight, these consumers had a bad credit rating, which means that they would borrow money or use their credit cards and make late payments, maybe default. So they were very high risk. And so what happened is banks offered loans to these consumers, and guess what? Not surprisingly, these consumers failed to pay on their mortgages. So when the economy started to turn after the dot-com and 9/11, and it took a while for the U.S. economy to pick up, these consumers that were high risk anyway lost jobs, and they had an inability to pay for their mortgages. And that caused lots and lots of problems. The other thing that happened after this in 2006 is that the price of houses had been going up, and suddenly it stalled, and then their values dropped. So what happened was these same subprime borrowers suddenly owed more on their house than their house was worth. And that, as a consumer, that made them think, well, gosh, I'm not going to pay as much for this mortgage or this house because it's not worth that anymore. And they walked away. This walking away caused a lot of financial institutions to collapse. They had put money out there and they were not having it repaid, and they suddenly were repossessing homes that weren't worth what they had spent money against. Consequently, they had to let employees go. And so as you see, it's a very complicated situation, but it had a huge ripple effect in the United States economy. So when this happened, there were steps taken by the federal government and the Federal Reserve to stop this. In 2008, Congress passed what was called the $700 billion TARP Act, which stands for Troubled Assets Relief Program. And it was a huge $700 billion economic bailout program. There was also the American Recovery and Reinvestment Act. And the goal of this program was to flush money into the economy through construction jobs, through highway improvements, and the purpose there was to get people working, and when people were earning money again, then they'd spend, and eventually the economy would turn around. Now, to help manage the economy and monetary policy, we need to understand how that has happened. And it is the feds that control money in the United States, and they shape or can shape and influence economic performance. So how do they do this? There is fiscal policy that they help to oversee, and fiscal policy is government efforts to influence the economy through taxation and spending. So when you hear about fiscal policy, think the government, think Congress, think state taxation. Now, monetary policy, this is influenced by the Federal Reserve, and they shape the economy by changing interest rates that banks are charged, and these interest rates help to control the supply of money that is flowing through the economy. Now, we hear a lot in the news about the debt ceiling and fiscal cliff. Well, what is this? So, a debt ceiling is the total amount of money that Congress allows the government to borrow. So, our government is constantly borrowing money, which is one reason why our deficit continues to grow. But there's limits to that, and those limits are set by Congress. And sometimes you will hear some bickering back and forth between the Republicans and the Democrats because one party will want to raise the debt ceiling, one will not. And so it becomes a pretty big political agenda. Now, fiscal cliff. A fiscal cliff is a package of across-the-board spending cuts and sharp tax hikes. So the purpose of a fiscal cliff is to help decrease the U.S. budget deficit, which under every president, regardless of their party affiliation, it has grown. Now, it's not necessarily beneficial for the U.S. economy to go over a fiscal cliff. The economy might not be in a place where it can repay some of its debt. And so some negotiations have to happen between both the Democrats and the Republicans to not go off the cliff and to maybe come to some agreement about how to manage the fiscal policy of the country, or monetary policy. Now, every year the government has to create a budget or a financial plan that outlines expected revenue from taxes and fees and their expected spending. In this budget, if there is a budget surplus, that means that revenue is higher than expenses over a given period of time. So that's where more taxes were collected than what they needed. Now, a budget deficit is when expenses are higher than revenue over a given period of time. This is when the government is spending more than it is bringing in from a tax revenue standpoint. And then we have the federal debt. Now, the federal debt is, you add up all the money that is borrowed and not yet repaid by the federal government. And this constitutes the federal debt of the United States, which is in the trillions of dollars. And like I said earlier, it continues to increase over time under every president, regardless of their party affiliation. So the Federal Reserve, we hear a lot about the Federal Reserve in the news. So the Federal Reserve is in charge of executing federal policies. They are made up of a 7-member board of governors, and the members of the board are appointed by the president. They serve a 14-year term, and the terms expire every 2 years. So what that does is creates a governing body that is constantly turning over, where you have some members that have served some of their time. They will stay while those who have served their term, they'll be retiring to be replaced by new members. And this is great because you have experienced board members that are helping to teach and guide and mentor new board members. Now, the Federal Reserve, what's kind of cool too is that the board members, when they're appointed on such a staggering cycle, the president is not able to assign the entire membership of the board, similar to the Supreme Court, where you have this rotation, this natural rotation. And that also helps to make the Federal Reserve more unbiased, and it helps to balance out those members that might be more liberal with those who might be more conservative. So it's kind of cool, this system of checks and balances. Now, there are commercial banks that are owned by the Federal Reserve banks, and these banks are distributed throughout specific districts. These are not the same as commercial banks like US Bank or Wells Fargo. These are government-run banks. And there are 12 of them. And these Federal Reserve banks carry out the Fed's policies, and they perform banking services for the commercial banks. So think of Wells Fargo. They're getting their money from a Federal Reserve bank. Now, money supply. So the core purpose of the Fed is to influence the size of the money supply, or the total amount of money that is in the economy. And we have to think about money as being a medium of exchange. It's a measure of value or means of payment. So don't think of it in terms of actual dollar bills. It can be euros, it can be drachmas, but it's some medium of exchange. Now, there's some commonly used definitions of money supply within the United States. One is M1, and M1 refers to all currencies plus checking accounts and traveler's checks. That's really important. So we separate types of money. M1 is all currency plus checking accounts and traveler's checks. M2 includes M1 plus most savings accounts, money market accounts, and certificates of deposit. So in 2012, M1, which again is all currency plus checking accounts and traveler's checks, M1 was $2.5 trillion, and M2 was $10.5 trillion. So we see where we can have shifts in the money between M1 and M2. Now, what happens when the economy contracts, which means consumers aren't spending, the Fed will increase the money supply. And the way that they do that is they tend to lower the interest rate, and that encourages people to take out loans. It encourages businesses to take out loans, and that helps to fuel the growth of the economy. On the opposite side, we have when prices are rising due to inflation, the Fed will reduce the money supply. And they do that primarily by raising interest, making the cost of money more expensive. And that causes businesses and consumers to take a pause and to think about, well, do I really need to make that purchase right now? And so there's a tightening up of the purse strings, and that helps to curb inflation. Now, on the open market, it is really the Fed that uses open market operations. And they do that by buying and selling government securities, such as treasury bonds, notes, and bills. When the economy is falling. The Fed will buy government securities on the open market. And the opposite, when inflation is a concern, the Fed will sell securities. Now, the open market is regulated by the Federal Open Market Committee, and the committee consists of 7 members of the Board of Governors and 5 of the 12 presidents of the Federal Reserve District banks. Now, there's also the Federal Deposit Insurance Corporation. And if you bank at Wells Fargo, B of A, US Bank, even some of your credit unions, you'll see usually in little tiny print, FDIC insured. Well, what that means is it's a federal agency that insures your deposits in banks and thrift institutions or credit unions for up to $250,000 per customer per bank. And the FDIC has been around since the Depression, when banks walked away with people's money. This is the FDIC gives assurances to consumers and businesses that their money is protected. And this all happens on the open market. Now, discount rate and reserve requirement. The discount rate is the rate of interest that the Federal Reserve charges when it loans funds to banks. So when Wells Fargo wants to borrow money from the federal government, they are charged an interest rate. This interest rate is called the discount rate. And if the Fed decreases the discount rate or the interest rate, it is easier for banks to take out loans at a lower cost. And this is positive because the bank will, in return, lower their interest rate to businesses and consumers. And that stimulates the economy. And the opposite will happen if they raise rates, the Federal Reserve raises rates, then banks will charge consumers and businesses more, and that will cause a contraction. Now, a reserve requirement is a rule that the Fed set out that tells the banks they have to maintain a certain minimum amount of money on hand. And they do that so that when consumers, it helps to create a safety net for consumers and businesses. So if you want to withdraw all of your money, the bank has to give that to you. And they have, their own savings account. And so they will pay you out of that savings account. Well, and what they generally have to hold on to is about 10% of their assets. And this is pretty standard. Sometimes it can vary a little bit, but 10% is the standard that banks must hold on to. Now, capitalism in the free market. So, an economic system in general is based on private ownership, economic freedom, and fair competition. So, this is an example, or I should say it is known as the private enterprise or free market system. And this is a system that the United States tends to use mostly, and it's also considered an economic system, and it's a way for allocating limited resources within a society. Now, there are some fundamental rights in capitalism. In order to succeed, the system has to ensure that there are some rights for all of the people who live within the economy. So under capitalism, you have the right to own a business and to keep the after-tax profits. You have the right to private property, the right to buy it, to use it, and to sell it. You also have the right to pass this property on to your heirs. You have the right to choose what you're purchasing or not purchasing. Businesses are free to buy what they want, and they're free to not buy a product that they don't want or need. Consumers and businesses are also free to choose where they want to work and where they want to live. And finally, a real strong foundation to the right of capitalism is the right to fair competition. So this means that you have the right to fair pricing, not deceptive pricing. You have a right to not be exposed to predatory pricing. And there's many foundations within this right to fair competition, and it's to make sure that everybody is operating on really the same playing field. Now, there's degrees of competition. So when we look at an economy, there are three basic structures. We have pure competition, and pure competition is a market structure that has lots of competitors that sell pretty much the same product. It is very easy to enter this market, and the barriers are low. Anyone can do it. So an example of that is agriculture. Anybody can raise a crop and sell it. It's not too hard to do. Now, in a monopolistic competitive environment, this is where there are many competitors selling different types of products. And again, the barriers to enter this market are reasonably low. The producers in a monopolistic environment have some control over the prices of their products, and those prices will depend on the value that they're offering to their customers. Now, oligopolies, this is a market structure with only a few competitors selling products that can be similar or very different. So it's very hard to enter these types of markets because the cost of getting set up to do business is extremely high. Some examples of that might be the automobile industry. So while you might be able to come up with your own design for a car, getting a plant in place, getting the technology to put those resources together, it's pretty high, so it's difficult. Now, a monopoly is an environment where there's one producer that completely dominates an industry, and it leaves very little room for any significant competitors. So the barriers to enter this type of market is almost impossible to overcome. So we have a natural monopoly, and a natural monopoly is a market that has one company as the supplier of a product, so one company, maybe two. And the reason for these types of markets is that the product, it's much easier for one supplier to make this product. And typically, these types of monopolies are government sanctioned and government regulated. Two local examples that we have, Portland General Electric, who produces electricity. This is a government sanctioned natural monopoly. And if you wanted to go out and dam the Willamette River so that you could sell your electricity, you would have a lot of problems doing that. And so PGE is an example of a natural monopoly. Now, in capitalism, we have supply and demand. And in a free market system, we have buyers and sellers that are continuously interacting. And this interaction helps to determine which products will be sold and what those prices should be. When we look specifically at supply, supply is the quantity of products that producers are willing to offer for sale at different market prices. And demand is the quantity of products that consumers are willing to buy at different market prices. You can have a great product that you're able to supply from a business standpoint, but if the consumer doesn't have a demand for the product, you're probably not going to be in business for very long. Now, from a business standpoint, so businesses their goal is to make as much money as possible. And how do they do that? Well, they make products that charge a higher market price. So they want to sell more of those types of products, and they want to sell less of a product that is not as profitable. And we see that in the cell phone business, where the newest and the latest iPhone will be $700, $800, $900 a phone, and earlier versions of the phone eventually you can't buy them anymore. The company does not want to sell them because they're not making any money. They would rather sell the higher end new product. Now, this is an example of the supply curve. So from a producer standpoint, as you are selling more and delivering more of a product, the price will tend to go up because you're selling something that somebody wants. Now, on the opposite side, we have demand. Now, demand is from the consumer standpoint. As a consumer, you want to buy more products at the cheapest price possible. And you want to, in terms of expensive items, you don't want to buy as much because that takes up more of your money. And we can graph this relationship from a consumer standpoint with the demand curve. Now notice that it is going down or in the opposite direction of the supply curve. So as consumers are purchasing more and more pizza in this example, the price tends to come down, and this is beneficial to consumers. So when we're looking at the interchange between demand and supply, we're looking for a place where those two lines intersect. And that point of intersection is called the equilibrium price. And that tells us where the suppliers can meet the demand and the consumers are willing to purchase it. And on this graph, we see that consumers are willing to purchase 80 pizzas a day And they're willing to do that at a price of $10. And that is a price that the producers are willing to sell it for. This is the equilibrium price. Can it or will it stay there? Maybe for a while, but we see these equilibrium prices changing over time. It is influenced by the cost of commodities or the raw materials to make the goods. Equilibrium price can change based on the amount of disposable income or general income that a consumer has. So these change, but the perfect point where supply and demand meet is called the equilibrium point. Now, another economic system that we see, especially in some countries such as many of the European countries, is called socialism. Now, socialism is a system that's based on the idea that the government owns and operates some of the key enterprises that directly affect the public welfare. In a socialistic economy, in order to support this, there tend to be higher taxes, and these taxes are designed to distribute wealth more evenly throughout society. Now, a cause of a slump in socialistic economies is there high taxes, and there is really a very lavish social program. We've seen some challenges in recent history in France, which is a socialistic economy where France doesn't have as many people working, and so their tax revenues have dropped, and yet people are still wanting the same benefits. So it is creating some tension. There's also a system of communism. And under communism, there is public ownership of all enterprises. And this is under the umbrella of a very strong central government. Karl Marx is the person who introduced communism in his book titled The Communist Manifesto. Now, some countries that have adopted communism are the Soviet Union, North Korea, and Vietnam. And all of these governments have failed. And the reason that they have failed is that these authoritarian governments got rid of individual choices. They had crippling shortages and surpluses where people could not get food, but there would be too many fishing poles, for example, things that they didn't need. And the government became highly, highly corrupt at every level. Well, in today's global economies, we're really seeing more of a mixed economy system. So pure economies, whether they're market economies or planned, they're not able to fulfill all the needs of its citizens. So this is really what is behind the migration towards more mixed economies. You have examples where the federal government owns a number of financial institutions, and they will intervene in the free market system by creating regulations. An example of this in the United States is what's commonly called Obamacare, where the government is getting involved in healthcare and access to healthcare and the prices of that. And we also see privatization, which is converting government-owned businesses into private ownership. There's some speculation right now that the post office may be going more towards private ownership because the government has not done a good job of running that institution. So how do we evaluate a market? We look at domestic gross product, we look at the employment level, business cycles, inflation rates, and productivity. Now, the gross domestic product, that we see this on the news all the time, and it's called GDP for short. So GDP is the value of all goods and services that are produced within a country's boundaries over any given time. You can have a company such as Toyota that is owned, corporate headquarters are in Japan, but Toyota has plants here in the United States. And any business that Toyota does here within the United States all contribute toward GDP. Now, obviously, with GDP, we don't have a way to measure, capture illegal activities or legal goods that are not required to be reported. That if there's no way to track that, then we don't know, and it's not included in that measurement. Unemployment, or the employment level, is tracked through the unemployment rate, and the unemployment rate is the percentage of people in the labor force over 16 who do not have jobs and are looking for jobs, actively seeking it. So we have 4 types of unemployment. So frictional, which means someone is temporarily unemployed. Maybe they were laid off, but within 6 months they have found a new job. There's structural unemployment, which is long-term, where someone who is highly skilled is not able to find a job for a very, very long time. There's cyclical, which tends to happen during layoffs. Freightliner is an example where if there's a recession and people aren't ordering trucks, then they will lay off their workforce until the orders start to come in again. And then, of course, there's seasonal unemployment, where people lose their jobs based on the time of year. We see that with holiday workers. We see that with agricultural workers, where you can only harvest crops during certain times of the year. Now, a business cycle, businesses go through periodic contractions where they're growing and expanding, or contracting where they're getting smaller, and then there's expansion where that's where they're growing. And that occurs over time. So contraction occurs during recessions, and a recession is considered a decline in the GDP for 2 consecutive quarters. And if it lasts longer than that, we have a depression, which is really a very severe and deep recession. Now, the recovery period is where we're bouncing back from a recession or a depression, and you have economic growth, and the unemployment rate starts to drop. And then there's times during expansion where you have a robust economic growth, you have high employment, businesses they're producing, people are working, and life is good. Now, price levels. We have inflation, which is a time when average prices are growing across the economy. And this can be a measure of, it helps us look at a country and whether or not it's in a good place. And then we have hyperinflation, which is where the average monthly inflation rate grows more than 50%, which is crazy, and it's where you want to buy your products today, because if you wait until tomorrow, it's going to cost you a whole lot more money. Now, disinflation is where we have a period of slowing average price increases across the economy. And we had that a few years ago in 2008, where prices were slowly coming down. And then deflation is a period where your average prices fall. As a consumer, I like that phase, as long as I'm employed. Now we have price indexes that also evaluate our economy. We have the Consumer Price Index, which evaluates the change in the weighted average price of goods and services that the consumer buys every month. So as of October 2015, the Consumer Price Index is actually pretty flat right now. And that's good. That means that prices are not going up, they're not going down, people are working. That's very positive for the economy. We also have the Producer Price Index, PPI, and that evaluates the change over time in the weighted average wholesale prices. So when you see a PPI start to go up, that means that eventually the CPI will go up, because if a store is being charged more for a product, they're going to pass that price increase on. And finally, we have the relationship of productivity. So that relationship between output and input. So this, again, is where you want that equilibrium, where a company is producing the exact amount of goods and services that consumers want. So you're able to get the resources that you need to produce goods. And the way that we calculate productivity from a mathematical standpoint is it's your output divided by your input. So looking back, we've defined economics and discussed the evolving global economic crisis starting with 9/11. We've looked at the impact of fiscal and monetary policy on the economy. We've evaluated the free market system with supply and demand. We've looked at planned market systems with socialism and communism. We've spent some time reviewing the trend towards mixed market systems, and then discussed key terms and tools to evaluate economic performance. So this concludes Chapter 2. If you go back to Buzz, please take your quiz and be sure to look for other assignments that are due. And if you have any questions, please contact me. I'm here to help you. Thank you, and have a great day.